How much should I expect to draw from my retirement portfolio? That's the question. In this video, I want to talk about that. I want to talk about the rules of thumb that are out there. I want to talk about the pitfalls of choosing some quote unquote guru's rule of thumb. And then I want to explain an alternative path to doing what you need to do to ensure that you can retire and not deplete the assets that you have. So, for those of you who don't know me, my name is Chris. I'm a licensed CPA and a financial advisor. I've been doing this for over 30 years. I do it daily. I work with clients every day. And what I'm going to explain to you and what I will give you towards the end of the video, I think will help you along your journey of determining what should I be withdrawing. So let's get to the question that popped up. The very first thing when you go out and search this, and all over my feeds, I don't know if you guys are getting the same thing, but it's this 4% rule that keeps popping up. 4%. I originally heard about the 4% rule when I, first was licensed. And I didn't think much of it at the time because I initially thought 4%, that's ridiculous. You have $1 million portfolio, 4% is 40,000. You got 10 years, that's 400,000. 20 years is 800,000. Hell, I've got 20 years if it never earns a dime. If I left it in cash. The danger is the downside. But so that's my experience with the 4% rule. And I've looked it up since, and we did a little testing. So you'll be interested to see what I found out. And I thought I understood it, and I just dismissed it. But when I dug in a little bit farther, that's not what the original research actually proposed. This 4% rule wasn't just 4% flat and take it out. It wasn't, hey, at the end of the year, recalculate what your new 4% is. If your market value came from $1 million down to 800,000, now your 4% is not 40,000, it's 32, or whatever the math is. Then I understood that this was originally designed by Bengen. Never heard his name pronounced, so forgive me. But what he actually was trying to do is test a withdrawal rate that would weather all storms based on past, information. But that's essentially what he was trying to do. It was a minimum or a safe haven, so to speak. So, 4%, yeah, I could just tell you take 3% out, right? 2%. At any rate, I tested that. And I also realized that in his original theory, there was the ability to increase that baseline amount. So the 4% of $1 million is 40,000, and then you increase it every year for inflation. And then I thought, wow, now that's a leap. Because if you have a portfolio and you start with $1 million and you take 40,000 out and it drops to 800,000, and then you take 41,200 because you've indexed it for some little amount of inflation, you're nowhere near 4% anymore. You're 5 or 6. We'll look at the numbers later, but I tested that. I used almost a century of historical market data, testing rolling 30-year retirement periods and compared to several different withdrawal approaches. And I was surprised at one of my methods. It didn't stand up as well as I thought, but I'll tell you about that later. Some confirmed what I thought, some didn't. And one completely changed the way I thought about retirement spending. So what the original 4% rule actually says, the research behind it was published by William Bengen, 1994. His basic approach was not to withdraw 4% of the current portfolio every year. It was to withdraw approximately 4% of the original portfolio and then increase it for inflation in future years. So that distinction, I think, matters a lot because after a significant market decline, You may technically be following the 4% rule, but what you effectively are drawing out may be an amount higher than that. Let's assume that. Let's take that. You retire with the $1 million, you withdraw 40 grand. Then the market has a bad year. Now your portfolio is worth 600,000, let's say. Inflation has also increased. So your plan to withdraw 42,500. So divide that, do the math. 42.5 divided by 600,000, you're at 7.1% of your portfolio you're pulling out. That part bothered me. So, I wanted to look at what it does in market downturns. I wanted to test market downturns and what each one of these philosophies produced. So what I tested, I started out with a hypothetical $1 million. Portfolio was invested 50% in the S&P 500, 50% in 10-year Treasury bonds. I tested a rolling 30-year retirement period using historical returns from 1928 through 2024. That produced 68 separate historical retirement periods. I tested the average withdrawals of 4%, 5%, 6%, 7%, and 8%. And I compared several approaches. First, to traditional annual rebalancing. This is what we do as financial advisors much of the time. We'll go in and just make annual rebalancing of the portfolio. And the idea behind that is stocks and bonds are inversely related. When the stock market's good, the bond market's bad. You sell high, buy low to rebalance. And the inverse is true. The bond market's good, the stock market's bad. You sell high and buy low and rebalance. That's typically what most will do. So I tested that rebalancing. Second, I tested a little liquidity strategy, because when people come to us, we advise liquidity. The first question out of my mouth generally is, what are your income needs? What do you need to live? That tells me how much liquid funds need to be available. That prevents me from selling an asset that I don't have to sell. There are a number of other ways to do this. You could utilize leverage inside a taxable account. You could utilize things as gain harvesting at 0% tax inside a taxable account. So there are other ways to do it, but the liquidity strategy, I think, is generally widely accepted. You attempt to avoid selling depressed assets. So the third thing I tested was a dynamic spending strategy. When you look at dynamic spending, that's what we're going to call it, you reduce spending when the portfolio falls. And you assign some parameters. And I tested that theory. When the portfolio is 80% of its value, reduce spending by 10%. If it got to 65% of its value, reduce spending by 20%. Those two scenarios I tested. I also tested something really much simpler, taking a fixed dollar withdrawal without automatically increasing it for inflation every year. What you'll find is retirees will initially spend more in their early years. In their later years, they're not as active. They will not spend as much. That's what I find. What I think is important to discern is what's discretionary spending needs and what's non-discretionary. That is really the question we should ask when I say, how much do you need? Need is one thing, want is another. You just adjust your wants. So let's get back to it. I took a fixed dollar withdrawal, automatically increasing it for inflation each year. That was my simpler approach, taking a fixed dollar and automatically increasing it for inflation. I didn't in any of these tests include taxes, investment fees, management fees, Social Security, income, anything like that. I wanted to isolate the relationship between portfolio returns and the withdrawal method. Historical results also did not guarantee future results, so I understood that. But historical testing can show us how different strategies behaved through recessions, inflation, wars, you name it, market crashes. So let's get to the results. The fixed dollar withdrawal results. Here's what happened. 100% success at 4%. At 5%, 98% success. At 6%, 95% success. And at 7%, 92%. At a fixed 8% withdrawal rate, it succeeded based on the past evidence in 70% of the cases. That shocked me. A retiree taking a fixed 60 grand from a 1 million portfolio survived approximately 96% of the historical 30-year periods tested. So let's jump into what happened when spending increased with inflation. I took the same set of information. The retiree took initial withdrawal and then increased that amount each month based on inflation. The results changed dramatically. 4%, survival rate was 97% of the time it would survive at 4%. Increased for inflation every year. That's where that 4% rule comes in. It's 97% survival. At 6%, it fell. Approximately half, 53% survival. That's with an automatic inflation-adjusted amount each year. At 8%, 20% chance of survival. So that was significantly different. The major difference between the last two examples that I gave you is one started at a flat rate and didn't increase, and one started at a flat rate and increased for inflation each year. We also have to ask, what happens to our spending after retirement begins? Is it automatically increased every year? Does spending ever decline? What happens after a terrible market? How much of the spending is essential? How much can it be adjusted? How much room do you have? Jumping from that, I took a liquidity management tack. So this strategy is generally it's after a negative stock market year. Take withdrawals from the bonds or items that are more liquid. This is when I tell you how much cash is in the portfolio. It's not just stocks, bonds. It's stocks, bonds, and cash, or whatever that mix may be. But it's generally more liquid to less liquid. After a negative stock market year, we take the withdrawal from bonds rather than selling stocks. After a non-negative stock market year, we take the withdrawal from stocks and rebalance the remaining portfolio to provide emergency liquidity. I expected this to outperform the other two, but it didn't. I tested a dynamic spending approach. Under this particular model, the retiree followed the liquidity strategy, but reduced spending when the portfolio fell below certain levels. If the portfolio fell below 80% of its original value, spending was reduced by 10%. If it fell below 65%, spending was reduced by 20%. Spending could later be restored after the portfolio recovered. These were modeling assumptions. They're not universal recommendations. At 4%, starting inflation adjusted withdrawal, the dynamic model survived 100% of the historical periods tested. And remember, this is 4% inflation-adjusted withdrawals, but applying those dynamics to it. All right, so at 5%, what happened with that model? It survived 79% of the time. At 6%, 60% of the time. At 7%, 41% of the time. So that dynamic spending helped but it didn't solve the underlying problem. At a 6% starting rate, the traditional inflation-adjusted approach succeeded 53% of the time. The dynamic approach improved to about 59% of the time. That's an improvement, but 59% is not something I would describe as a retirement plan. It's not dependable. It's close to a coin toss. The dramatic result in my testing did not come from occasional 10 or 20% spending cuts. It came from not automatically increasing the withdrawal rate every year for inflation. This is where I'm all going with this. This is where it's coming down to the decision that the way that many common sense investors approach this is better. My point is, build a flexible plan. Be honest with yourself about your assumptions. What I see day to day is people who come in, retire, tell me what they need, and it turns out to be not true. Both sides of the spectrum. They tell me, I only need this much money, and then they're calling every week to draft more money. Or they tell me, yeah, I need a bunch of money. And they don't, because they get out, they retire, they get bored, they start consulting. Hell, they may be making more money than when they started retirement. So everyone's different. But what has to occur is you have to be flexible in your strategy. Real retirees do not spend like robots. The traditional model assumes that spending begins at a certain amount. It increases every year for inflation, and it stops at a certain amount. And many people spend more in the first part of their retirement and later in the last part of the retirement. Now, some don't. Some have medical problems. Some, who knows? My point is, all of this needs to be adjusted. It all needs to be visited every year. You need to sit down with your financial advisor, look at what you have, and then talk about your spending needs. So that 4% rule, it's helpful. It's maybe a start as to, can I retire? So if you came to me and said, I can live on 4% of my income adjusted for inflation each and every year, okay, you can retire. How happy you be, I won't have a clue. Because we haven't talked about anything else. We haven't talked about your passions, your hobbies, your goals for retirement. If you take one thing away from all this, know that retirement is a planning exercise, and it's done yearly. It's not what is the highest amount I can possibly take out. The better question is, how much of my spending is essential? How much is discretionary? What income begins later? What expenses may disappear? What major expenses could arise? And the last, how much do I want to leave my heirs? I built a tool. I'm putting it on my school community. It's going to be free for a while. Well, I'm building that whole community, so there's nothing there yet except this tool and a couple of guests or members. Join. Let's all learn from each other. Let's participate. Let's build. The tool will be there. Go get it. And it's not a magic green light. It's not a future predictor. It's not a crystal ball. This tool is a Excel workbook. It will allow you to enter some parameters and then determine based on historical facts, historical trends, and it'll let you determine how close to a danger zone you may be in. So if you're interested in this kind of retirement planning, not simply repeating rules of thumb, but looking at taxes, spending, historical results, and actual trade-offs, subscribe, please. It incentivizes me to do more. I'm continuing this work in my school community called Financial Freedom Path. I'll put that information in the description. And the goal, remember, is not to engineer mathematically perfect retirement. The goal is to make better decisions with the retirement that you actually have. Thank you for watching.